All right, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bale, certified public accountant, long-term bobblehead investor, author of the book Stop Being a Broke Loser, and hater of garbage stocks. Now today, we're going to talk about the stock that's all the rage, probably on Wall Street Bets, on Jim Cramer's show. This is the Chinese Uber. It's called Didi. But in reality, it is a steaming pile of doo-doo. Now let's go look and see what happened at the Didi IPO. And remember, ladies and gentlemen, I always tell you, don't buy into IPOs because most likely the stock's going to freaking crash and you're going to lose your butt, okay? If you only invested in IPOs, you probably end up down on the truck stop in retirement selling your butt. All right, so let's go and look at Didi. So Didi is currently trading for $12.41. But let's see what happened during the IPO. Oh, wow. Look, it was listed on June 30. Am I sharing my screen? Jesus, I'm not sharing my screen. Sorry. Okay, starting that again. Didi was listed on June 30th, 2020 at $18 a share. And of course, look what happened right after the IPO. Boom. Now we're down to $12 and something cents. So if you'd invested in this hot garbage right at the IPO, like me, Kevin probably told you, or Wall Street Bets, you'd be down 31%, okay? And I know a lot of you clowns claim to be long-term investors, but you're actually not, okay? A lot of you are just trading in and out of securities. So Didi right off the bat has freaking crashed. And the reason it did that was because of the Chinese government. Didi crashes after China ban. Regulators warned to wait for U.S. IPO. The Chinese-based ride-hailing app and Uber competitor saw its stock shares fall over the holiday as China's cyberspace administrator pulled the Didi Chuxing app from stores in China, citing cybersecurity risks at the issue. Now, look, ladies and gentlemen, there is a lot of risk, number one, investing in IPOs. And on top of that, there's also even more risk to invest in an IPO of a foreign issuer, especially from China, because the Chinese government can just lay the freaking hammer and completely screw you over, okay? Now, here's something freaking hilarious that I saw. So we got this clown, Jim Cramer. I know a lot of you may know about him. He's the guy that goes, buy, sell, sell, sell. This guy is a total moron, and he exemplifies the hype and speculation and stupidity of the average Wall Street broker and entertainer. Now, here's what Jim Cramer said on June 28th. He said, get as many Didi shares as you can after the Chinese ride-hailing giant goes public, okay? So he told you, you got to go ahead and just get as many shares as you can. And if you did that, you would have got your cheeks clapped. And then, of course, so this is June 28th, remember. And then, of course, on July 6th, Stock Market Today with Jim Cramer. Stay away from Didi. So, Jim Cramer, the clown, the fraud, the degenerate, told you on June 28th to buy into Didi because it's the future, bro. And then, in early July, after it tanked probably, he said, oh my God, stay away from that. It's a bunch of BS. So, if you're listening to Jim Cramer for financial advice, you need to freaking ignore him, okay? You'll be much better off just investing in total world stock market index funds in tax advantage accounts. Now, let's go ahead and look at some of the numbers of Didi. Didi Global Incorporated, okay? So it looks like they started generating revenues in 2018. So we have, what is that, 135 billion of revenues in 2018, 154 billion of revenues in 2019, and then a decline in 2020, but that's understandable, okay? But I don't really care about revenue so much as I care about profitability. And here's one thing I don't like, ladies and gentlemen. You see this operating income? Now, when you make revenues, you actually have expenses of your business. You have cost of goods sold, cost of sales, like paying the drivers, and then you have all the selling, general, and administrative expenses. Now, what's left over after you pay all those other expenses is your operating income. And look at Didi's operating income. Wow, negative 12 billion in 2018, negative 8 billion in 2019, negative 13 billion in 2020, and over the last 12 months, negative 17 billion. Wow, that's some major profits right there, ladies and gentlemen. Now, we don't just have to look at it from the accrual basis of accounting. We can also look at it from a free cash flow perspective. Now, free cash flow, you take your operating cash flow, which is the cash you generate from your business, minus investments in capital expenditures. So buying crap for your business, basically. And whatever's left over is what the company has to buy back shares, pay back dividends, and whatever. You want positive and growing free cash flow. Now, if you look at Didi, free cash flow, this line right here. Oh, I see a bunch of negative numbers, okay? What does that tell me? This stock is total speculative trash, all right? This is one of the typical stocks that these growth investors are all into, because the average YouTube growth investor doesn't have to justify anything. All they have to do is pick a new and exciting stock and make these wild projections into the future. And even if they're proven wrong, by the time that future comes into fruition, they've already made a ton of money off of YouTube ad revenue and their Patreons, whatever stupid courses they want to sign you up for. But if you're just looking at this pile of trash, negative operating income, negative net income, negative free cash flow, operating cash flow, barely breaking even and then going down over the last 12 months. Now, you would think coming out of the pandemic that their operating cash flow would, increase because now they're, doing more business. But of course, they're not. So just looking at these numbers, this is freaking trash, okay? Now, you can do your own due diligence. And if you think this recent crash, because it's down to 1245, maybe it's time to buy the dip, ladies and gentlemen, if you're a growth investor. But in my humble opinion, until I see free cash flows that are positive and growing, I'm not touching this freaking company, okay? And on top of that, you want to go and look at the offering statement. You want to look at the financial statements. And you want to dig into the details, read the risk factors, management's discussion and analysis, the financial statements, the notes of the financial statements, to really understand how this company makes money. Now, let's go ahead and check out the risk factors with this report that was filed by Didi at the Securities and Exchange Commission. So, okay, risk factors. I like how they actually have links. A lot of these financial reports don't have links. All right, so let's look at some of the risks of this company, because all these YOLO growth YouTube investors, they don't care about risks. They say, oh, this is a futuristic stock. It's a disruptor. It has AI, whatever. It's the future. That's all they care about, okay? But I like to read about the risks of a company. So I've already looked at the financials. They're not profitable. They're bleeding cash, okay? Number two, there's a lot of risk when it comes to China, all right? Especially with these new companies. And I even said that for Alibaba. I bought into Alibaba. Doesn't mean you have to, but I'm taking a lot of risk. And there's a reason that Alibaba shares are much lower than they probably should be. It's because of the risk of the Chinese government laying the hammer on these corporations, all right? So let's look at some of the risks. And I saw some delicious ones. We have incurred significant losses since inception, and we may not achieve or maintain profitability. Now, if you see that line, come on, ladies and gentlemen, they're not even profiting from an operating level. It's freaking garbage. We have incurred losses of 12.4 billion Chinese currency units, 8 billion and 13 billion, okay, over 2018, 2019, and 2020. So you would think, they're growing, they're expanding, but over time, you want to see at least them starting to move towards profitability. If you look at these numbers, they're not freaking profiting. They're bleeding money horribly. Jesus. All right, let's see what else. Our limited operating history and our evolving business make it difficult to evaluate our future prospects and the risks and challenges we may encounter. Yes, that is what these growth investor YouTubers do. They don't care how long the company's been around. They don't care about profitability. They just show you a couple of news articles, hype up the stock, and then say, well, 10 years down the road, this is going to be a cash cow. It's unsubstantiated garbage, but that's what they say to attract you into buying their stupid stocks that they're pumping. And all the while, they're collecting that delicious ad revenue. And who gets screwed at the end of the day? Probably you. All right, let's keep looking. The shared mobility industry is highly competitive. We may not be able to compete effectively. Wow. Okay. Usually you want to invest in a business that has a wide moat, because if there's low barriers to entry, then it's really hard for the business to, keep raising prices and remain really, really profitable. But if a business has a wide moat, it's much more probable that that business can maintain profitability and survive into the future. But with all these new companies popping up, who knows how long they're going to last, okay? Not even profitable, no moat, bleeding cash, freaking trash, all right? I saw something else about taxes. I'm really looking at that. Taxes. All right, well, it was somewhere in here, but basically they get like a special tax break, or not even a tax break, but basically the Chinese government has the ability, if they want to slap on a certain tax. And right now they're not paying this tax. So they're already not profitable. And then if the Chinese government decides, oh, you know what, we're just going to go ahead and tax you on whatever, that would actually hurt the business's future prospects of profitability even more. And if they did have a profit, well, they're probably going to be paying a higher tax rate. Another risk that I saw in here, there's like 1,000 risk factors, they're all buried in there, is that all the independent contractors may have to be classified as employees. This is the same risk that Uber had. Now, if you have to classify a contractor as an employee, you actually have to pay additional taxes, all right? Normally, contractors, you just pay them a flat amount or a certain amount of money, and then the contractor has to file their own Schedule C, at least in the United States, which is a business profit and loss form on their tax return. So you don't have to worry about paying them health care, the freaking wages, Social Security taxes, Medicare taxes, unemployment benefits. You don't have to pay any of that crap with an independent contractor. But if a new regulation comes out and this company is then required to start paying all these extra costs, their cost of sales is going to increase, which means they're going to have to raise prices, which may hurt them compared to their competitors, okay? This company is freaking garbage. And if you're listening to people like Jim Cramer or whatever other clowns that are pumping the stock, you're going to get screwed. Stay away from this hot garbage. Wait until it's actually profitable and you see free cash flow that's positive and it's growing, because then you can start applying metrics like, projecting how much the free cash flow is going to grow over the next 5 years using historical growth rates. And then you can say and kind of guesstimate what multiple of free cash flow people are going to be willing to pay for this company in the future. And that's how you can kind of arrive at a market cap for the company, okay? But right now, if it's bleeding money, it's not profitable, there's a ton of risks, and it's in China where they can get their hands slapped pretty easily, it's not a good idea to invest in this company. I mean, look what happened at the IPO. If you bought in, you would have got clapped. But don't listen to me. I don't have twinkly eyes like a standard YouTuber. I don't wear a suit. That means I don't know anything, right? Anyway, this company's freaking garbage. Let's go look at some comments, then I'm going to head out. Meet Kevin is a steaming pile of doo-doo. Yes, he is. Strong man. Screw college. So Didi is a buy now. Yeah, buy the dip, bro. I wouldn't buy it. How's the fam? Very good. 8 viewers, new record high. I've had like 13 at one point. But anyway, if you like this video, please like and subscribe to my channel. Buy my book, Stop Being a Broke Loser. It's for $3 on Amazon. Tell your friends about me. And don't buy Didi stock, okay? It's a lot of risk. There's no profits. It's bleeding cash. A lot of regulations that could be slapped on it. It's garbage. Anyway, y'all have a delicious day.